So the first question, this is a new company, made sales on account for $400,000. Company estimates warranty repair 3% of the sales. Now the actual warranty payments were 9,000, and we have to record the warranty expenses, warranty payment on December 31st, and how much is the estimated warranty payable at the end of the period. So what we have to do is we have to do few journal entries here. Let me see the dates. So everything is on December 31st. Nothing more, nothing less. So on December 31st, what we have? We have to record first the sales. Let's record the sales. The sales is the number one that we have to record. Let's record those sales. On December 31st, we're gonna do debit accounts receivable since they're selling everything on account for 400,000, and credit. It's gonna go. Credit's gonna go to sales for 400,000. That's very straightforward, nothing scary here. Next one is we have to record the warranty expense for the year to match the sales. So for the warranty expense, we have to first calculate the warranty expense. They're saying that they estimate the warranty repair will be 3% of the sales. So let's do the entry based on the 3%, December 31st. We're gonna have debit warranty expense. And that will be here, if you have to put a note, that will base on the 400,000 times 3%. 100,000 times 0.03. So the warranty expense provision is $12,000. So now they have to create some account. That will be credit, will be estimated warranty liability. That will be one way to see it. The account or an estimated warranty payable on the other. That's one way to see it. Either you can gonna see it payable, either you can see it liability. But since it's payable, automatically means that the account is liability account. There's nothing hidden here, and that will be for the same amount, 12,000. Now, the actual payment comes, and the actual payment for the period was for 9,000. And for the actual payment, we're gonna use directly cash. So now when client comes and claim the warranty, we're not gonna do another warranty expense because we already did the warranty expense. When the client come and claim the warranty, we go and directly we're gonna debit estimated warranty payable account. And we're gonna start reducing that account. Estimated warranty payable account, that will be for 9,000. And in this case, let's assume that we pay everything cash. And 9,000 will be in the other side to balance the entry. Now, the question is, what's the balance of the warranty payable account? In order to see the balance, what we have to do, we have to draw this T account here, which we're gonna do it. Which account is gonna have beginning balance and it's going to have ending balance. Now it's a liability account. Be careful with that. So if once it's liability account, we already know that those liability accounts, they have normal balances always credit. That will be credit on this side. Debit will be on this side. Now, is it possible beginning balance in the very beginning, the beginning balance for this account was 0. Then we added on December 31st, 12,000 on the credit side. And after that, we debited the account with 9,000. So the ending balance for this account will be equal to 0 plus 12,000 minus 9,000. So the ending balance will be 3,000. And that's your question for the warranty accrual or warranty liability and warranty payment. Now the deviation of the question is if the client requests a replacement of the item that he purchased. So that we're not going to create cash, we're going to create directly inventory. That will be the only twist here in this. For those of you who are interested, is it possible this account to end up with debit balance? Yes, it is possible. Is that going to happen on the exam? No. But in reality, in real life, is it possible the account to end up with debit balance? Yes, it is possible. What that means? That means that the 3% are not accurate. So company has to change the estimate for the warranty. Means that in that case, the company pays more than showing us expenses. So basically the product that they're selling is not in the good quality. That's with this question. So label it question 1. And let's keep going with the next one. Again, I'm going to use this one. Will be question 2. And let's copy the question 2 and now from the Word document that I show you. In the very beginning, I'll keep going with that Word document. That will be question 2. Oops. Sorry, wrong pasting like this. So suppose that this company is in Victoria, British Columbia, made the sales 3,000 on April, subject to 5% GST and 7% PST. Record the sale and recorded consumption taxes. Also record the payment of the PST to provincial government and GST to receiver general on May 10th. Now what we have to assume, let me grab this one. What we have to assume, we have to assume the input tax credit amount is $69. So what I'm gonna do, I'm gonna delete some deletion here. And now we can start. Which account we're gonna chase here? We have to chase 2 accounts. We have to chase GST payable and GST recoverable. Now what will be the difference? The difference will be the balance that's sitting in those accounts. So the GST payable account, since it's payable, that's a liability account. Obviously, that account's going to have credit balance. Let's assume beginning balance is 0. And we're going to see what's happened with this account. Now, then we're going to have another account, which will be the GST recoverable. recoverable, and we already know that this account, now this account has a debit balance because we're gonna recover something from the government, and we already know that input tax credit amount is $69. So we know that this amount here is 69. What's happened above, it's irrelevant. So now let's go, April. Now we have to change the date. That will be 30th April. 30th of 04. Let's change the format of the date or 04 30th, if that's, there we go. April 30th. On April 30th, we have to make the sales. Now, suppose the private tutoring company made cash sales, so they collected cash if they're making cash sales. So now the question is, which account we're gonna create? Since it's the sales, we're gonna create a sales revenue. And that sales revenue gonna have $3,000. Then we have to charge the clients for the GST, and we have to charge the client for the PST. So automatically we're gonna have credit GST payable, which will be for the amount of 3,000 times 0.05%, 150. And then we have another amount we have to plug in here, and that will be for the PST. I'll push this one down a little bit. The credit will be PST payable. And the PST payable will be 7% of the 3,210. So the client has to pay us exactly the same amount of 3,000 plus 150 for 210. So the client has to pay us 3,360. And we're done with this. Now, it comes May 10. That's not 10/05. That should be May 0510. Let's see if that's gonna work. No. Okay. Yeah, I have to change the format of the date. Let me change that one. And that will be 10/05, May 10. We may have this one, we may not have. Let's have it. Let's do separate payment for the GST and separate payment for the PST. Let's deal first with the PST. PST, we have to pay it, no questions about it. So first, let's clear that PST payable, debit PST payable for the amount of 210, and government doesn't want anything but cash. So let's give them that cash. So they don't have to chase us. Credit will be cash. Now let's deal with the GST account. Now the GST account, we're going to have two amounts, zero balance here. We already have the GST recoverable has a balance of 69 on recovery. Now we have to close this account to zero. So we have to create this account with 69. That's how we're going to bring it to zero. And then on the GST payable, again, beginning balance zero. Then we have one transaction on April 30th, which will be this one. April 30th, we have $150. So in this account, we have debit credit balance 150. So we have to debit this account with the same amount. So that will be our debit. Let's mark it with different colors, not like that. More like put some font here. That will be our debit, that will be our credit. So let's go. May 10. First, we have to debit GST payable account to clear the balance, which balance we set is $150. Then we have to credit GST, excuse me, recoverable account with $69. And obviously we have to pay the difference. Once we subtract what we can recover from what we have to pay them the difference. And government doesn't want anything but cash, so let's give them the cash. This one minus 69. So that's how on the next period, GST payable account will now is zero. As of as of May 10, the balance of this account will be zero, and GST recoverable will be zero, and we can start accumulate again to see what's going to happen for the month of May. That's question 2. Let's keep going. Question 3. Again, I'm going to grab the question 3 from the Word document and I'm going to post it right here for you. So for this question, what's happening is this company, you see if you can still see my screen. Yes, you can still see my screen. This company on July 31st, 2022, they purchased 32,000 of inventory on 1 year, 6% not payable. So we have to journalize the company accrual interest for December 31st, 2022, and the payment on not plus the interest on July 31st, 2023. Okay, let's go. First, we're gonna have here July 31st. What's happened on July 31st? We get the inventory, and that inventory is for 32,000. Now, for that inventory, we didn't pay because obviously we don't have cash, but we issue not payable. So if you want, you can specify it. You can go with the short term not payable. If you want to be more specific, you can even go with that direction. So what's interesting in the short term not payable, that comes with 6% annual interest. Okay, so I don't need this thing here, so I can easily erase it. Okay. Now I can erase that. Okay, this one gone. Nothing. So what's interesting with this not? Not, or if you want, let's go with the right terminology, short-term notes payable. We have the short-term notes payable, and that short-term notes payable is for 32,000. Interest annual is 6%. Now, in total annual interest is gonna be 32,000 times 6%. It's gonna cost us $1,920. Since we purchased the equipment on July 31st, the interest is gonna start counting from August. So what we have to do? This is the total annual interest, which is for 12 months. What we have to do? Very simple. July 31st, so we start paying interest from August 2022 to December 2022. Now, how many months we have here? Somebody jump on the 5 months. Okay, let's put 5 months. And what's happened next? Next happened that then we have to get the January 2023 to end of July 2023. How many months we have here?
I was
From
about to say 7.
So question for you.
January, February,
So
March,
watch
April.
this. For how long is this not payable? For 1 year, correct?
Yeah.
What's the term? Let's go here. I'm gonna insert one line here.
Okay.
Now I'm gonna cancel this one. I'm gonna insert one line here. I'm gonna push it down, and that will be term. Term in years.
Okay.
How much is the term per year? In years. Total 1 year, right?
Yeah.
Okay. How many months the year has?
12 months?
12 months. Is it possible? So now, if from August to December is 5 months, is it possible from January to July to be 6 months? Is that
6
possible?
plus 6 plus 5 is 11, so technically kind of yes.
Is it possible to be 1 year? Is it possible the period
Um,
from January to July to be 6 months? January 1st to July 31st. That will be August 01st to December 31st. If you have to be specific, and that will be January 01st, and that will be July 31st. So now the question is, we clearly have here 5 months, and we have 1 year not payable. On the payment date, is it possible this number here to be 6? Yes or no only. No explanations. Is it possible?
there's a whole bunch of
No.
no's in the chat.
No. So that means no. So if for some reason you get 6 here, you're wrong. Is it possible to be 8? No.
No.
You can get yourself total months per year. And you can get here calculation. Boom, to check yourself. So is it possible the total months per year to be 13? No. So you have to come here and adjust the number. That will be 7. Now it's possible. So now, what you have to do? Once you have the number of the months, you have to get, very simple, you have to get annual interest per month. Sorry. Yes, annual interest per month. Or interest per month only. Then let's push it down. And how much will be the interest total interest per month? How much will be? This number divided by 12, correct? 160 per month. So how much will be the interest expense for the 5 months? 160 times 5. How much will be the interest expense from January to July 31st? 160 times 7. Do we get the annual interest of 1,920? Yes.
Yes.
So now once you have this, now you can do your journal entries. What you have to do? You have to just remember that this one is the interest that you're gonna accrue on December 31st. So on December 31st, we're gonna do interest expense for the amount of $800. And since we're not paying cash, we're gonna go with interest payable. What's gonna happen on July 31st? On July 31st, I'm gonna do it not with one entry, with two entries. First, I'm gonna do with the two entries, then I'm gonna show you with one entry. 31st 07, July 31st. That will be my debit here. First thing, let's deal with the interest first. Let's get the first, we're gonna pay the interest payable. Make sure you clear this interest payable. Second, we're gonna show the other interest expense for the 7 months, which will be for the amount of this one, we're gonna be 800. This one's gonna be 1,200. So we're gonna show this amount. Let me highlight it in different color. So the first expense here is this one, the blue one. So the blue, this was the blue. The second interest expense is this amount. And we have to pay cash. How much interest we have to pay? We already know, 1,220. When I combine those two, do I have 1,220? We should have it. It's gonna be this one plus that one. We pay the interest. Now let's pay the principal now. And on July 31st, we're gonna, okay, let's get those one. On July 31st, let's get debit. That will be short-term notes payable with the $32,000. And credit will be people they want cash. And we're gonna pay them cash, $32,000. And we're done. Now, how can you do it with one combined entry? You just have to add short-term notes payable in the first one and increase the cash. So how it's gonna look like? It's gonna look on 31st, or if the person asks you for one entry, then you're gonna do December 0, 31st July. You're gonna do debit interest payable, debit interest expense. That's not the one we're looking for. Second, interest expense. Next one is debit short-term note payable. and I'm gonna plug the numbers. So from this entry, I'm gonna get the interest payable, 800. From then I'm gonna get interest expense. From the second entry, I'm gonna get the note payable, and I'm gonna close everything in cash. And my cash will be this one plus that one. That's how you're doing this combined entry, if you want to go that direction. And that's called combined entry. Now I want to highlight it. No, maybe like this. But I still want to highlight this one different color so you can understand that this is the interest expense. And this is the short-term note payable that we paying, and from the very, very, very beginning when we created. And that's our interest payable. Let's use the different color. That will be this one. And now we fully colorful from everywhere. That makes sense? Okay, let's go with the next one. I'm gonna grab this one. I'm gonna flip it here because the question 3 become too colorful. That's question 3. That's this. I don't need this one. Let's delete this one. And let's get this one. That will be question 4. Let me save this file somewhere, just in case, because I don't want to lose it. That will be midterm exam questions. Okay, now it's safe. If something goes wrong, we're still gonna have it. Let's go now question 4 on the Word document. That will be another question with the taxes. Sorry, the GST. So, this company on July 10, a business purchased 15,000 inventory for resale on account. They recorded sales on the merchandise on account 20,000 plus tax. On August 10, they remitted GST to a receiver general. They have no other sales and input tax credits. Now what we have to do to analyze those transactions. So again, we're going to have the GST payable. Let's get rid of those numbers. And we're going to have the GST recoverable. Now, our beginning balance is 0, and we have to come up with the ending balance. Ending balance will be the beginning balance plus entries here. Here, this balance is going to be equal to this one plus sum of all those sums. Okay, let's go one after another. First one, let's buy the inventory on account. That will be July 10, and we're going to have inventory. And we buy 15,000 inventory. So far, so good. Unfortunately, we have to, the supplier from which we buying the 15,000, he charges GST. So that will be our GST recoverable. And since we know that's 5%, it's going to be 15,000 times 0.05. Let's try again. This one times 0.05. $750. Now what we have to do, we have to create the accounts payable. That will be payable. And accounts payable in this case will be 15,000 plus 750. We're done with this. Then we're going July 25th. On July 25th, sales on account. So now we're going to have, instead of accounts payable, we're going to have receivable. Accounts receivable, that's accounts receivable will be 20. No, we don't know how much it will be. Let's go with the sales first. Revenue. And the sales revenue will be 20,000. Now we have to charge the client GST. Credit will be GST payable, which will be 5% of the 20,000. $1,000 the client's gonna pay us, and the client has to pay us in the future 21,000. Now on August 10, we have to finish and see where we are. So what we have so far, we have accounts GST payable on 25th of July for $1,000. And then we have GST recoverable from 10th of July for 750. So we have to debit GST payable with 1,000. We have to credit GST recover 750. And we have to pay the government $250 cash. Then we're done. Do you see anything scary with this type of questions with the GST? Let me see what you say in the chat room. Question 3 is from, let me see, question 3, short term. That's from chapter, that will be short-term liability. That will be chapter 11. Okay, let's move on for the next question, which will be question 5. Now in question 5, same idea. I'm gonna go to the file that I gave you, and I'm gonna post. This one is a little bit more interesting. Let's see how interesting can go. Okay, that's our question. Question. Let's name it question 5. Just give me a second. I'm just gonna go for a second. I'm gonna stop just for a second. So what we have to do is we have to record the payroll deduction, employer payroll cost, given the following information on Ontario company on March 31st. March 31st, we have a gross pay 190,000, income tax 22,000 deduction, Canada pension plan 9,300, employment insurance 3,500, registered retirement saving plans contribution of $10,000, union dues deduction for 2,945. In addition to registered retirement saving plan, deducted from the employee, the employer make contribution to 1% of the gross pay to the company pension plan on behalf of the employee. Let's go. First, let's do the expenses for the payroll. That will be 31st03rd. Debit, that will be salary expenses. Are those salary people or pay or hourly people? It doesn't say. Let's go with the salary expenses. And that salary expenses will be $190,000. After that comes credits. Let's see how many credits we have to do. First, we have to deduct income tax and we have to pay to the government. That's for, so those are the money that the employee never gonna see. 22,800. Then we have to deduct Canada pension plan payable because we have to pay it eventually. That will be 9,300. Taking from the employee. Next one, we're gonna credit employment insurance payable, and we're gonna take it from the employee $3,500. All this amount. Next thing, we're gonna credit, and we're gonna take from the employee. We have to do their RSP payable. We have to contribute those money, take it from the employee, and put it in their RSP accounts. That will be 10,000. And the last one, the employee has to pay their union dues. And that will be for 2,945. The rest is going to be salary payable. That's going to be 190 minus the sum of all those. So the employee, we're going to pay them eventually $141,455. Their deductions will be for the amount of $48,545. That's for the employee. Let's see what's going to happen with the employer. Now the employer, he's going to start salary benefits or employee benefits. Let me see what's the exact amount here. Employee benefits. And that will be expenses for the company. How much it's going to be, we have to see. First, remember, employer has to match Canada pension plan. 1-to-1 or 1-to-1 ratio. So that will be exactly equal to Canada pension plan. Then employer has to make a contribution to employment insurance payable, and that is in ratio to 1 to 1.4. So that will be this amount times 1.4. There's one more thing that employer has to do. As you can see, in the addition to registered saving plan that the employee makes, the employer contributes 1% of the gross pay, not the net pay, the gross pay to the company pension plan. So what's the gross pay? Gross pay is 190,000. As you can see, gross pay here, 190,000. So let's make contribution for the CPP payable, and that we can specify to here employee, 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 employee. That will be here not going to be employee, it's going to be employer. Same thing with this. It's going to be employer. And the last one is registered retirement saving plan, payable, employer. And that will be 1% of the gross amount. We have the gross amount, we're just going to apply the 1%. This one times 1%. So in total, the employee benefits for the employer to pay them $190 gonna be, we have to add the last amount, this one, $16,100. Now this question doesn't say when we paying the employee, but if the payment date comes, what we have to do, we have to clear everything and credit cash. And there's so many things that we have to clear. Let's pretend that we have to pay those employees and we have to clear everything. Let's say that's on June 2nd. We have to pay. That's our payroll payment date. So what we have to do, we have to start all the payables. Debit. Let's copy this debit because there will be a lot of debits here. First, we have to debit for salary payable. Let's first pay the employee. Then we're gonna start paying income tax payable. Then we're gonna have Canada Pension Plan employee, Canada Pension Plan employer, em employment insurance employee, employment insurance employer. Then we're gonna have registered retirement saving plans employee, registered retirement saving plan employer. Then we're gonna have union dues for the employee, and we're done. And everything's gonna go on cash. So how much company has to pay? The company has to pay this one first. Let's format this thing to be the same. Then they're gonna pay this. Then they're gonna pay this. Then they're gonna pay one more time that one. Employment insurance for the employer, employment insurance for the employee, RSP for the employee, RSP for the employer, and union dues. So the total cash that the employer has to pay is going to be equal to all those together. 206,100. Let's see if the gross pay plus the employee benefits expenses is the same amount. Magically, it's exactly the same amount. So now the employer has to pay. So the total cost for the employer is $206,100. That's with the payroll questions. Questions on those payroll questions.
Quick question. The stuff are being debited because like we already paid them, right?
Where?
No, like the salaries payable, the income tax payable, the CPP
Yes,
payable,
yes, because
because
we
we
pay.
already paid it.
Now we're paying them. On June 2nd, we're paying everything.
Oh, okay. Okay, that makes sense. Thank you.
I'm adding this one just to show you this is not on the question. This is
Oh,
something
okay.
that I'm adding.
Oh,
This is
okay.
this is additional from me so you can see the payment.
Okay. Can you also upload? Okay, like the stuff are already uploaded online. I just checked.
Yes. The
Okay,
questions I've
good.
uploaded online. So now after the lecture, I'm gonna upload this Excel spreadsheet
Yeah,
as well.
another question as well. Uh, Joban said he lost his connection earlier, and did Ivan, answer when the midterm will be available and what date we have to
No,
finish
no,
it?
I haven't answered that one yet.
Oh, okay.
We're still okay. I'm holding it so I can have more people. Tricky, right? But anyway, I'm gonna send you email with announcements, through the announcements, when the midterm is available and more details about the midterm. So now let's keep going with the question. Let me check what's the next question available. So now the the answers that are posted on the Word document are the answers directly from the Pearson. I know I'm deviating a little bit, but check the answers on the Word document and make the adjustments in your head. That will be the first file, Word document file. Now let's move to the second one. Instead of giving you a break, I'm gonna keep going so we can finish. Once we finish, we finish. Okay? Are you guys gonna be okay with that?
Yeah, I'll be okay with that, I guess. So long as it's prior to 8:30.
How's the majority? Okay. Yes, 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 yes. Do you have any? Do you have the rate such a multiplier by 1.4? That will be the only thing that I want you to memorize if you have to memorize something. The multiplier for the employment insurance 1.4. I mean, we already talked about so many times for that about that. So please just put it in your head. If you're planning to be an accountant, if you're planning to do payroll, you have to have 1.4 in your head. Just stick it there, don't move it.
Sorry, and the
One
1.4 was basically for the EI.
employment for the employment insurance. Deduction for the
And
employer, for the employer.
okay, and that won't actually change despite like
No,
10
that's
years
not.
into the future.
No, no, not at not unforeseeable future. If there's any changes, you're gonna see on the tax courses. You're gonna see those.
Oh, okay. Okay, thank you.
Okay, let's move to the next one. This one will be something that you're gonna love or not, maybe. I will see. Just in a second. That will be question 6. So we have those selected accounts for the company. Let's put the question here. Let's paste it here. Now we have to get the accounts for the selected accounts for the company. And then we're gonna get the requirements. It's gonna be a little bit messy here, but we're gonna figure out. So those are the selected accounts. And those are the balances that those selected accounts have. Okay, so I have to delete some of those. Pretty much everything. Let's delete everything. So what we have to do, the question asks us to prepare equity section of the company balance sheet. The good thing for you is the company name and the state name of the statement, those will be given to you. So you don't have to, worry about those one. So you're gonna have them. What you have to do is start with the contributed capital and you're gonna split it by 2 sections, contributed capital and retained earnings. So we're gonna start first with the contributed capital. Now which one we're gonna list first? Preferred shares or common shares?
From my memory, I say preferred.
Why?
Because like there was one time that one question you gave out on chapter 14 where it said that like the preferred shares comes first because of the fact that that when we had to pay like them to the employer, not to the employer, but like to our shareholders, the preferred always comes first because they have voting rights or something along those lines.
Okay. They don't
Yeah.
have, so now the preferred shares, they don't have voting rights, but they have
Oh, okay. Sorry. I think I
preferred,
made a mistake with
right,
common shares
right.
then.
They have preferred dividend. Because they have preferred dividend, they're first on the line.
Oh,
So we
okay.
get it.
Okay.
So the other thing that you can do is once you look in the question, let's highlight in green which one is the part of the shareholders equity section and which one is not. Common share, is this part of the shareholders' equity section? Yes or no? Say something because I cannot monitor the chat right now. Is the common shares part of the shareholders' equity section? Yes, okay. Let's mark it green. Accumulated amortization machinery equipment, is this part of the shareholders' equity section? Yes or no? Okay, I'm gonna monitor the chat. Accumulated amortization, machinery and equipment. No. Okay. So this one is red. Retained earnings, is this part of the shareholders' equity? You must say yes. Let's mark it yes. Cost of goods sold, is it part of the shareholders' equity? No. Thank you, Xiaolin. Inventory, is this part of the shareholders' equity? No. Thank you, Xiaolin. Machinery and equipment, is it part? No. Thank you again, Xiaolin. Also, Shamash. Preferred shares, is it part? Well, obviously, we already put it, right? And the last one, organizational cost net. Why question mark? I want to see solid no. Thank you. That's better. Okay, so I think we're done here. We did get the preferred shares first. Second one will be the common shares. Let's get the common shares. We get the common shares. So how much will be our contributed capital? If we want to write down the section to close that contributed capital, we're going to say the total contributed capital, which is total contributed capital. So that's like this, and that's going to be those two together. I can put a line here and make this wider. That's my contributed capital. Then the next one is the retained earnings. See, paste the retained earnings here. And since it's only one element, the last thing that I have to do is total shareholders equity, which is going to be only those two. And if you want, once we're on Excel, we can make it fancy, just like that. Can get rid of this line, and we can highlight this one to be more professional. And we're done. You can put dollar amount here if you want to be perfect, to be look professional. Absolutely. Put the dollar amount on the first number, put the dollar amount on the last number, double line it, the last line, and we're done. Questions for this? The tricky part here is to identify which accounts are balance sheet for the question 6 have a formal title as a separate financial statement should just say shareholders equity. Because we just so listen, on the shareholders equity is a separate statement. Usually it's a separate statement. Because on the shareholder statement equities section statement, sorry, we explicitly say what's the contributed capital from where, what's the constitute, and what's the retained earnings. On the balance sheet, when we're preparing balance sheet, we're just gonna show total shareholders equity. Nothing more, nothing less. So you're gonna have a current liability, long-term liability, total shareholders equity, or you can have section total contributed capital, retained earnings, total shareholders' equity. If you want to see from where the contributed capital comes from, go to the shareholder equity. But this one is the shareholders' equity section of the company balance sheet. So it's like a partial part of the balance sheet. It's not actual equity section, equity shareholders' equity statement. That's the only thing here. Okay, let's move on for the next question.
Is it just me or is the screen frozen?
It is probably no, I'm not doing anything. I'm just looking the case and trying to get the question. So I can post the question. It's not you. So right now we're gonna move to trying to find something here. This one. Let's try this. That will be question 7. Okay, we have this thing. So record the journal entry on April 18 for each of the following cases. We have case A and we have case B. So case A, let's go with the case A. Record, that's April 18. Debit, issue shares and buy the asset in separate transactions. Issue 11 common, so 11,000, that will be issued 11,000 shares, common shares for cash of 1,460,000. In a separate transaction, issue the cash to purchase the office equipment. Use the cash to purchase office building and office equipment. So let's do this. Debit, what the company get on on case 1? What the company get?
Cash.
Absolutely. And we have the amount of cash, which is 1,460,123. What the investor get?
Common shares.
Common shares. So we have to create common shares. We don't, so issue 11,000 common shares. That will be 11,123. And we can get the average price. The per share, that will be for the same amount, obviously. So how much will be the book value per share? We can easily calculate it. It's gonna be, let's see, that will be this one divided by the 11,000. 132.73 is the book value, 132.73. That makes sense? Should be. Okay, let's not question it. Let's move on. Next one. They use the cash on April, still on the April 18. They use that cash and they purchase office building. So they get the office building. Then they get equipment. And they pay everything cash. How much was the office building that they purchased? 900,000. The equipment was for 560,000. And how much cash they use? I believe they use entire cash. That's one option. Now let's go with the part B. In part B, they issue 11,000 to acquire building of 900 and equipment worth 560. So what we're gonna do here? On 1804, debit. What we're gonna debit now? What the company get in the second case? They had office building, right?
Yeah.
For 900,000,
Yeah, because it's an asset.
right?
Yeah.
Then they get equipment for 560,000. And then what they issued? They issued common shares. 1460123. What's the difference between one and the other? Is there, in general, is there any difference?
Well, there's no cash moving.
No cash. In both cases, there's no cash. Cash is zero,
Mhm.
right? So is there, once we look at accounting balances, what we have? We have common shares here for this one. Let's mark it as blue, matching this one, right? Cash gone. This cash, eliminate that cash. And then we have office building 900,000. Office building 100,000. And we have equipment 560 and equipment 560. What's the difference? Is there any difference between one and the other?
I feel like the difference would be the owner of the shares, the common shares.
Well, yeah, that might be one thing. That will be one thing. Yeah, you might be right. If we go in the practical kind of exercise, it might be the shareholders. But if the owner of the company is the person who owns the building and the equipment, he just transfer it to the company, get the common shares, then that will be eliminated. The other thing that you can see is the second case is now it's gonna be questionable, right? The value of the office building and equipment, that's gonna be questioned by the auditors. Why? How did you come up with the fair market value? Because on the second case, we have to use the fair market value to come up with the value of the office building and equipment. Where in the first case, you just buy it cash. You have the receipts, you have the invoices, you have the supporting documentation, end of the story. That will be the only complication here. But in the first case, now we're not using cash, so everything will be e-transfer or electronic fund transfer. So you don't have to worry about carrying $1,460,000 cash. Okay, let's go with the next question. I think that's the only questions that I prepare for you, which is not fair. Let me come up with some new questions then. Before we come up with the new questions, let me check what's waiting for you on the exam. And let's give you now some ideas about the exam. Obviously, I'm not going to share my screen when I'm talking about the exam, sorry. Okay, midterm exam is right here. In the midterm exam, you will have in total 36 questions.
Are the questions on Pearson?
Yes. So first, you're going to start with, there'll be multiple choice questions, 5 multiple choice questions for each chapter. Chapter 11, 5 multiple choice questions. Chapter 10, 5 multiple choice questions. Chapter 13, 5 multiple choice questions. Chapter 14, 5 multiple choice questions. Now from chapter 11, on the liability, you're going to have question for the warranty. Pretty much the question that we did. That's one thing. Then you're going to have question for warranty will be the first. You're going to have question for the GST. And you have to come up with the GST recoverable, GST payable, that kind of thing. Then you're going to have question from chapter 11 for the not payable, the one that I show you. So you covered on that one. And the next one you're going to have is payroll. The one that we talk about, similar. So you have to come up with how much is the employee deduction, how much is the employer deduction, all those things. All those questions you already saw on the assignment. Now from those will be from chapter 11. Now from chapter 13. You're going to have a question on the dividend. On the declaration date, date of records, and the payment date. Plus you have to close the retained earning account. Income summary account in the retained earnings, which is repetition from 11:10. On chapter 13, you also gonna have to calculate me the book value for preferred shares and book value for common shares. Only the book value. Careful with the book value. Book value will be amount that you have on the part of the balance sheet for the common shares, preferred shares divided by the number of shares. Then you have to show me in chapter 13 that you can distribute dividend to the preferred shares and common shares. With different scenarios, when they're cumulative, when they're not cumulative, how much one gets, how much the other gets. Because be careful with the cumulative. And that's about chapter 13. Now chapter 14. On the chapter 14, you're gonna have a question when you're repurchasing your shares back. And you go first, you're gonna create the contributed surplus, and then you have to make sure that you eliminate the contributed surplus, and if there's anything more that you need, you have to take it from the retained earnings. You have to calculate me earnings per share. So for that reason, you need to know how to calculate weighted average number of shares from the Excel spreadsheet that I already gave you. Statement of retained earnings. I want you to show me the statement of retained earnings. On retained earnings, you're going to have the beginning balance plus net income minus the dividend. And you're going to tell me how much is the ending balance. If you have to repurchase shares and use retained earnings, be careful with that. And the last one is the statement of the shareholders' equity. Now, probably for the same, so the statement of the shareholders' equity, I can show you here on the Excel spreadsheet, so you can have an idea how to do this. That's with the chapter 11, 13, and 14. Now let's see chapter 10. On chapter 10, you're going to have 1, 2, 3, 4, 5 questions. First, how we dealing with when we're disposing asset? So what you have to do, you have to be careful here, because once we selling the asset, you have to close the asset account for the machinery or for whatever it is. You have to close the accumulated amortization account related to that asset, and the rest is going to come as a cash. If there's a gain and loss, you can show the gain and loss. That will be very straightforward. Then we're going to have question when you have to calculate me again with the disposal. You have to calculate and see, do we have commercial substance or not? That will be the only thing. You have to calculate the gain and loss, but again, the gain and loss is going to come obviously from how much cash you're going to get, how much is the purchase book value of the asset, how much is the accumulated amortization. So if the book value minus accumulated amortization plus the cash is more than the book value of the asset, you're going to get gain. If it's less, you're going to have loss. That will be the tricky part here. You have to show me that you understand which one is cost, which one is expense, and which one is repair, betterment, and all those things, which is very straightforward. There's nothing here. And the last one is I want you to calculate me the amortization under the straight line method, unit of production, and double declining. And that will be your exam. So you're going to have 20 multiple choice questions and 16 separate questions, which 16 separate questions make it 1, 2, 3, 4 questions from chapter 10. I guess 4, 4, 4. 1, 2, 3, 4 questions from chapter 14. 1, 2, 3, 4. So 1, 2, 3, 4 questions from chapter 13. 1, 2, 3, 4 questions from chapter 11. Which questions you already saw on the assignment, so there will be nothing. There's not going to be something new that you're going to see. So now the exam's going to be available. Do you want an exam available from Saturday, this Saturday, 14th?
No, I have something going on that day that I need to go
No, no,
to.
no, no, no. Listen. That's the starting date for everybody. but you don't have to do it on the 14th.
Okay.
Okay. And the exam's gonna close itself on the 18th or 19th. Which one you want?
19th, please. The
Exam's
latest.
gonna the exam's gonna close itself on the 19th.
Sounds good.
It's gonna require you to use the log browser. So you're gonna have exam available from Saturday, this Saturday, 12 a.m. until next Thursday, 11:59 p.m. So you're gonna have it Saturday, Sunday, Monday, Tuesday, Wednesday, Thursday, 6 days. Anytime or during those 6 days, you can do the exam. You're gonna have only one attempt, obviously. You're gonna have more than enough time.
What chapter is the warranty question?
Warranty questions, chapter 11. You're gonna see, once you submit the exam, you're gonna see only the final score. And if you want to see, to review your test, you have to come and see me after you submit.
Ivan,
Yes.
after 8:30, can I talk to you privately about like my quiz result and like what questions I got
After
wrong?
8:30, let's see if we can finish 8:30. You want me to give you a break at 8:30?
Yes, please. I have something to
Okay.
drink.
Yes, I know. So let's see your questions. Let me try to address those questions here. 36 questions. Yes, 36 questions. Are the multiple choice questions calculation type questions or fact-based? Both. You're going to have mix. So you're going to have questions on the theory, questions on the calculations. So the midterm are organized in chapter order. For example, no, there will be mixed questions. What would be the end date? Thursday. How should we prepare for the multiple choice questions? You have the quizzes available, obviously. And the other thing is, at the end of each chapter, there's a section with the multiple choice section with the multiple choice questions. That will be another source for you to. Is it 2 hours? No, it's not 2 hours. It's more like 4.5 hours. Is it gonna need? Are you gonna need 4.5 hours? I don't think so. If you're organized and if you are focused, you should be able to finish within 2 hours. 2 hours and 30 minutes max. But I give you extra time so you don't have to stress yourself. So you're gonna have time to drink and go to washroom. I believe that's fair. Which lockdown browser are we gonna use? Once you turn the exam, you're gonna see. On the blackboard, if it says that the exam is available until Friday, no, that's I just changed it. It's not anymore. That was preliminary before I talked to you. Now it's 19. How many hours the total of the exam? More than enough. 4.5 hours definitely. Would it be possible to start the exam on the 16th and then the exam next weekend on the 16th and the exam on the next weekend? I have to set up the dates for everybody so no one is how can I say affected. So I believe this window from 14 all the way to 19. So if you want to the exam from 16, you have it the exam on 16, 17, 18, 19. If you have it on if you want to do it this weekend, you can do it this weekend. One suggestion though, if you're trying to do the exam on this weekend, please make sure you clear all your assignments first. Okay, let's give you some break right now. And after the break, come up with more questions if you want. And let's talk about more questions.